Welcome to another deep dive. Today we're taking a close look at LT Foods Limited, our mission for you. To quickly distill the critical insights from their recent investor call, we're focusing squarely on future growth, strategy, and what it all means from an investor's viewpoint. We're pulling insights directly from their Q4 and FY25 earnings call transcript, top management stuff. So the big question is, what are their strategic moves and financial health really signaling? And how should you interpret all this? Okay, let's dig in.
Exactly. And looking at their recent performance, LT Foods has built a genuinely strong foundation. They finished FY25 with pretty robust top-line growth. It was 8% in Q4 and 12% for the full year. That's revenue over 8,700 crores, which is, well, over $1 billion US for our international listeners. And this growth wasn't just luck, it was driven by core basmati specialty rice, plus good expansion in organic food and ingredients.
Those are impressive numbers, and it's clear they're not just sticking to rice. They've really been strategically expanding the product portfolio, haven't they?
Absolutely. They've moved into ready-to-cook, ready-to-heat meals, healthy snacks, even health-focused rice. And what's interesting is how they're mirroring this globally. Big projects in the UK and a successful entry into Saudi Arabia. That's apparently progressing right on schedule. So this global footprint, it really broadens their market.
Okay, so strong base, wider reach. What are they aiming for next year, FY26? Growth-wise, profitability.
Right, so for FY26, the target is ambitious. Consolidated revenue of ours, 10,000 crores. They're expecting overall volume growth around 7%, maybe a bit more. India's looking even stronger, 9% to 10% volume growth projected there. And they have this really remarkable gross profit margin expansion in FY25. Jumped to 34.5% from 32.5%, mostly favorable input prices.
But wait, despite that great gross margin jump, the EBITDA margin only nudged up a little for FY25. What held that back?
Yeah, that's a crucial point.
Yeah.
Several things hit it. Higher logistic costs, increased admin costs, especially in the UK with a new facility, and importantly, higher advertising spends. Now, here's the interesting bit for FY26. Logistic costs should normalize, come down a bit, but advertising spend, that's actually set to increase further.
Oh, really?
Yes, but it's strategic. They see it as an investment, vital for grabbing new consumers, sustaining growth in these, double-digit growth markets. The target EBITDA margin is around 13% for FY26, so they're confident these investments will pay off.
Okay, that makes sense. Investing for the long haul. Now, shifting gears a bit, how resilient is their business? Like, in tough economic times, the sources mentioned something interesting there.
This is where it gets really compelling, I think, for investors. Historically in the U.S., during downturns like 2009, 10, or even COVID, home consumption of food, including their products, it actually tends to go up. They've seen basically no negative demand impact during those periods, which speaks volumes, right?
Yeah.
About how essential their products are, kind of recession-proof.
That's a great characteristic to have. What about those U.S. tariffs, the 10% ones? Are they just passing that cost on?
Well, apparently not. The company stated they're being offset by lower raw material costs, so no price hike needed for customers, which, shows good operational control, good supply chain management. They can absorb shocks.
Right. Resilient managing costs. And they're not just defending, they're expanding through acquisitions too. Tell us about this global green group deal. What's the thinking there?
Yeah, this looks like a strategic push into canned foods. The deal's valued around 25 million, so about ours, 200 crores. They're expecting good synergies, aiming for a return on equity in the 20s. Pretty ambitious. Oh, and for their Golden Star jasmine rice business, sourced from Thailand. Duties have been passed on there, and margins should improve as freight costs normalize.
Okay, significant move. Let's talk overall financial health. Their return on capital employed, the ROCE, that saw a really impressive jump.
Indeed. ROCE improved significantly, went from 14% up to 21% in FY25. And that's not just a number, right? It means they're getting much more profit from the capital they use. Big sign of efficiency. Looking ahead, CapEx for FY26 is projected at RSED 340 crores. Mostly for warehousing and a ready-to-heat facility in the U.S. Important note, this figure doesn't include potential stake buyouts. Those would be extra opportunistic.
That financial discipline, it really stands out. And they're forecasting something pretty remarkable for their debt too, aren't they?
Yes, this is a major highlight. They expect their India and U.S. operations to become completely debt-free, and maybe even cash surplus from July onwards. Wow.
Debt-free.
Debt-free in India and U.S., yeah. Any remaining debt would be mainly in Europe. This financial flexibility, it's a huge advantage. Opens up possibilities. And one more thing, they strategically bought extra patty inventory when prices were good. It kind of suggests they might be optimistic about even stronger growth than they're officially projecting. A quiet confidence, maybe?
So there you have it. You've just unpacked the key strategic and financial insights from LT Foods' recent earnings call, a pretty thorough understanding of where they might be headed.
Right. So thinking about it, strong brands, market resilience, and now potentially debt-free in key markets like India and the U.S. How might this newfound financial muscle, this flexibility, really change their game? How could it influence their strategic investments, their growth plans in the next few years? What does it really mean for their ability to scale up, maybe diversify even more now that they have such solid financial ground beneath them? Something to think about.